Hello, I'm Dr. William Schlosser. You know me as an economist. You may also know me as an ecologist. But more than anything, you're going to know me as an educator. I'm Dr. Bill, and I welcome you to my classroom. We will delve into the intricate world of monetary policy, the actions undertaken by the central bank, such as the Federal Reserve, to influence the availability and cost of money and credit to help promote national economic goals. The Federal Reserve, often simply called the Fed, plays a pivotal role in the United States economy. Established in 1913, the Federal Reserve is the central bank of the United States. Its primary objectives are to manage inflation, regulate banks, and ensure financial stability. The Fed's decisions impact interest rates, inflation, and overall economic growth, making it a cornerstone of economic policy. In this chapter, we'll explore how the Fed uses various tools to achieve its goals, the effects of these policies on the economy, and the debates surrounding their effectiveness. Understanding the monetary policy is crucial for grasping how economies are steered through turbulent times and how growth is nurtured. Now, let's take a moment to look into the mirror and see what happens when past Federal Reserve decisions are scrutinized. As we turn to Milton Friedman, interviewing former chairman of the Fed, the situations discussed stem from 1970 when William Matten was the chairman of the Fed. It may have been about conditions some 70 years ago, but some of the struggles they faced are strikingly similar to what we are seeing in 2024. Milton Friedman is and has been a source of economics reasoning. We step into their discussions in 2012.
Why is it we haven't had the courage and don't, and under what circumstances will we? And I want to start with Bill Martin because his experience is a very interesting experience. His 19 years was divided into different periods. In the first period, that average that Burl Sprinkle spoke about averaged two very different periods. An early period of very slow growth and slow inflation, a later period of what at the time was regarded as creeping inflation. Now we'd be delighted to get back to it. People don't remember that at the time that Mr. Nixon introduced price and wage controls in 1971 to control an outrageous inflation, the rate of inflation was 4.5% per year. Today we'd regard that as a major achievement. But the latter part of the period when you were chairman was a period when the inflation rate was starting to creep up and money growth rate was also creeping up. Now, if I go from your period, you were eloquent in your statements to the public, to the press, to everyone about the evils of inflation and about the determination of the Federal Reserve not to be the architect of inflation. Your successor, Arthur Burns, was just as eloquent, made exactly the same kinds of statements, as effectively, and again, over and over again, said the Federal Reserve will not be the architect of inflation. His successor, Mr. G. William Miller, made the same speeches and the same statements and the same protestations. His successor, Paul Volcker, he is making the same statements. Now, my question to you is, why is it that there has been such a striking difference between the excellent pronouncements of all chairmen of the Fed? Therefore, it's not personal on you. You have a lot of company, unfortunately, for the country. Why is it that there's been such a wide diversion between the excellent pronouncements on the one hand and what I regard as a very poor performance on the other?
Because monetary policy is not the only element. Fiscal policy is equally important.
You're shifting the buck to the Treasury.
Yes.
To the Congress. We'll get to Mr. Brown.
Yeah,
don't
that's
worry.
Right. The relationship of fiscal policy to monetary policy is one of the important things.
Could you remind us, the general audience, when you say fiscal policy, what you mean in distinction to monetary policy?
Well, taxation, the raising revenue.
And spending.
And spending.
And deficits.
And deficits, yes, exactly. And I think that you have to realize that when I've talked for a long time about the independence of the Federal Reserve, that's independence within the government, not independence of the government. And I've worked consistently with the Treasury to try to see that the government is financed. Now, this gets back to spending. The government says they're going to spend a certain amount, and then it turns out they don't spend that amount. It doubles.
The job of the Federal Reserve is not to run government spending. It's not to run government taxation. The job of the Federal Reserve is to control the money supply. And I believe, frankly, I have always believed, as you know, that these are excuses and not reasons for
Well,
the
that's where you and I
performance.
differ, because I think we would be irresponsible if we didn't take into account the needs and what the government is saying and doing. I think if we just went on our own irresponsibly, I say it on this because I was in the Treasury before I came to the Fed, and I know the other side of the picture. I think we'd be rightly condemned by the American people and by the electorate.
Every central bank in this world, including the German central bank, including the Federal Reserve System, has the technical capacity to make the money supply do over a period of 2 or 3 or 4 months, not daily, but over a period, has the technical capacity to control it.
Dr.
They have not
is that right now?
cannot
True?
explain the kind of excessive money creation that has occurred in terms of the technical incapacity of the Federal Reserve System or of the German Central Bank or the Bank of England or any other central bank in the world.
Our central bank, the Federal Reserve, plays a crucial role in maintaining high employment and stabilizing prices for consumers in the U.S. economy. One of the main tools the Fed uses to influence the economy is by adjusting interest rates, the cost of borrowing money. When interest rates are high, borrowing becomes more expensive, meaning consumers pay more for things like homes and car loans. Businesses also borrow less to invest in growth. As a result, the economy tends to slow down when interest rates are high. However, there's a benefit. Higher interest rates mean that savings accounts and money market accounts earn more, which can be appealing to savers. On the other hand, when the Fed lowers interest rates, it makes borrowing cheaper, which encourages companies to take out loans, invest in growth, and expand their operations. This can boost economic activity. However, lower interest rates also mean that the returns on savings accounts decrease. This is part of the Fed's expansionary monetary policy, which can stimulate the economy. It's typically used to combat slow growth or high unemployment. Yet, stimulating the economy too much can lead to higher inflation. In economics, there are always trade-offs, and managing these requires a delicate balance. When the Federal Reserve was created in 1913, its primary goal was to prevent bank runs. A bank run happens when investors in the bank take the money out as cash and hold it out of the bank. However, the devastating economic impact of the Great Depression in the 1930s led Congress to expand the Fed's role significantly. They amended the Federal Reserve Act to mandate the full act so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. Since World War II, the Federal Reserve has adopted an active monetary policy to fulfill their broader responsibilities. Monetary policy involves the strategic actions taken by the Federal Reserve to manage the money supply and influence interest rates. These measures are essential for achieving key macroeconomic objectives, such as controlling inflation, fostering economic growth, and ensuring a stable financial system. Understanding the role of the Federal Reserve and its monetary policy is crucial for comprehending how economic stability and growth are maintained. The Fed's actions have far-reaching implications, impacting everything from the employment rates to the cost of borrowing money. The Federal Reserve has 4 primary monetary policy goals. 1. Price stability. 2. High employment. 3. Stability of financial markets and institutions. And 4. Economic growth. In this section, we will explore each of these goals in turn. Price stability is crucial for maintaining the purchasing power of money and ensuring predictable economic conditions. High employment reflects a healthy labor market, where resources are fully utilized. Stability of financial markets and institutions ensures a robust financial system that supports economic activity. And finally, economic growth signifies a rising standard of living and increased prosperity. While the Fed's control over monetary policy and interest rates is central to achieving price stability and financial stability, its influence on real variables like employment and economic growth is more indirect. The textbook highlights that increases in per capita real GDP are primarily driven by labor productivity growth. This productivity growth results from increases in the quantity of capital per hour worked and advancements in technology, rather than changes in the money supply. Understanding these goals and the Fed's role in pursuing them is essential for grasping the broader impact of monetary policy on the economy. Price stability is one of the primary goals of the Federal Reserve. The following figures show CPI, the Consumer Price Index, PPI, the Producer Price Index, and PCE, Personal Consumption Expenditures, to reveal different measurements of inflation in the United States. Rising prices erode the value of money as a medium of exchange and a store of value. Consequently, policymakers in most countries pursue price stability to maintain economic stability and public confidence in the currency. During the 1950s and 1960s, the inflation rate in the United States was generally about 4% or less. However, during the 1970s, the inflation rate increased significantly, peaking between 1979 and 1981, when it averaged more than 10% per year. This period of high inflation prompted the Federal Chairman, Paul Volcker, to make fighting inflation his top policy goal. Since then, price stability has remained a key policy goal for the Federal Reserve. After 1992, the inflation rate typically stayed below 4%, although increases in oil prices pushed it above 5% during the summer of 2008. The recession that followed caused several months of deflation and a falling price level in early 2009. The inflation rate is often measured as a percentage change in the Consumer Price Index from the same month of the previous year. Understanding these metrics helps us appreciate the importance of maintaining price stability for economic health and growth. The Consumer Price Index, or CPI, is often used as an indicator of inflation by U.S. consumers due to its relevance as a measure of the cost of living. The CPI includes the cost of essential items such as food, fuel, electricity, clothes, and drink. One of the key advantages of the CPI is its availability on a monthly basis, with a lag time of only 20 days after the month ends. This timely data makes the CPI a valuable tool for planning and reacting to economic events, helping consumers and policymakers make informed decisions based on the latest economic trends. The Producer Price Index, the PPI, is another critical measure of inflation, reflecting the average change over time in the selling prices received by domestic producers. Unlike the Consumer Price Index, CPI, which measures price changes from the purchaser's perspective, the PPI looks at prices from the seller's point of view. The PPI includes the prices for raw materials, intermediate goods, and finished goods, providing a comprehensive view of inflation at a different stage of production. This data is essential for businesses and policymakers because it can signal emerging inflationary pressures before they reach the consumer level. By monitoring the PPI, we can gain insights into the cost dynamics faced by producers, which can impact pricing strategies, profitability, and economic planning. It's a valuable tool for understanding inflation trends and making informed decisions on both the public and private sectors. The Trimmed Mean Personal Consumption Expenditures, PCE, inflation rate, produced by the Federal Reserve Bank of Dallas, offers an alternative measure of core inflation in the price index for personal consumption expenditures. Unlike the traditional core PCE, which excludes food and energy prices, the Trimmed Mean PCE provides a more refined analysis of inflationary trends by excluding the most volatile price changes. This measure is calculated by sorting the individual price changes of personal consumption expenditures in ascending order, from the largest decreases to the largest increases. A certain fraction of the most extreme observations at both ends are trimmed, or excluded from analysis. The inflation rate is then determined as a weighted average of the remaining components. By focusing on the more stable price changes, the Trimmed Mean PCE is a more accurate proxy for the true core inflation rate, offering a clearer picture of underlying inflationary trends.
Research has shown that this method outperforms the conventional core PCE, which excludes only food and energy prices, making it a valuable tool for policymakers and economists in understanding and responding to inflationary dynamics. At the end of World War II, Congress passed the Employment Act of 1946, which stated that it was the responsibility of the federal government to foster and promote conditions under which there will be afforded useful employment for those able, willing, and seeking work, and to promote maximum employment, production, and purchasing power. This legislation established what is now known as the dual mandate of the Federal Reserve, supporting maximum employment and ensuring price stability. The Federal Reserve uses various tools to achieve these goals, with open market operations, OMOs, being one of the most significant. Through OMOs, the Fed can influence the amount of money in the banking system by buying or selling U.S. Treasury securities, commonly known as Treasury bills or T-bills. When the Fed purchases these securities from its primary dealers, it increases the reserves of these dealers' banks, lowering the federal funds rate and encouraging lending and investment. Conversely, selling these securities reduces the reserves in the banking system, raising interest rates, and helping to curb inflation. By adjusting the monetary supply and influencing interest rates, the Fed aims to create a stable economic environment, conducive to sustainable growth and high employment levels. These actions are crucial for maintaining economic stability and promoting confidence among consumers and businesses. Beyond influencing the level of prices and the level of output in the near term, the Federal Reserve plays a crucial role in maintaining the stability of financial markets and institutions. This stability is essential for the overall health and growth of the economy. Modern financial systems are highly complex and interdependent, which makes them vulnerable to systematic disruptions. These disruptions can arise from various factors, such as a sudden plunge in stock prices or financial crisis. The Fed's role in such scenarios are to act as a lender of last resort. By making funds available to banks during times of crisis, the Fed ensures that these institutions remain solvent and that the public maintains a confidence level in the financial system. A notable example of the Fed's intervention was during the 2008 financial crisis. In response to the liquidity problems faced by investment banks, the Fed extended its discount window loans to these institutions temporarily. This move was crucial in easing the liquidity problems and stabilizing the financial system during the period of significant turmoil. More recently, the COVID-19 pandemic led to an unprecedented economic shutdown in 2020, resulting in a severe recession. The Federal Reserve responded by implementing a series of emergency measures, including cutting interest rates to near zero, purchasing large amounts of Treasury and mortgage-backed securities, and establishing lending programs to support businesses and municipalities. These actions were pivotal in maintaining liquidity, supporting financial markets, and preventing a deeper economic downturn. By containing the financial disruptions and preventing further problems outside of the financial sector, the Federal Reserve contributes to a stable and robust economic performance. The responsibilities to both the Great Recession and the COVID-19 recession demonstrate the Fed's crucial role in navigating economic crises. The Federal Reserve plays an important role in maintaining the stability of the financial system and fostering economic growth. Stable economic growth is essential for encouraging long-term investments, which are themselves vital for sustaining economic development. However, the extent to which the Federal Reserve directly influences long-run investments is limited. The Fed's primary tools, such as open market operations and the discount window, are more geared toward maintaining short-term economic stability and liquidity. These actions helped to cushion the economic blow and facilitated a faster recovery. Despite these efforts, promoting long-term economic growth often requires coordinated action with other branches of the government. Congress and the President play a significant role in this regard, through fiscal policy measures such as infrastructure spending, tax incentives, and regulatory reforms that encourage investment and innovation. Overall, while the Federal Reserve is pivotal in maintaining economic stability, achieving sustainable long-term growth necessitates a broader policy approach involving various governmental and institutional stakeholders.
So tomorrow's a huge day for Jay Powell and the Fed, in part because of their own dot plot, right? What they put out there sort of to guide their own sort of decision making suggests maybe they're already too late when it comes to cutting rates. I'm going to bring in now MonetaryMacro.com CIO Joseph Wong. And Joe, you kind of put this out there, right? And this is the dot plot. So PCE 2.6, 2.8 for the end of the year. We're already at 2.6. Unemployment rate 4.0. We're 4.1. I think the question, though, when you look at this is why wouldn't they be cutting tomorrow?
Hey, Charles, thanks for having me. And you're exactly right. So looking at inflation, Fed is way ahead of schedule. Core PCE, 2.6% year over year ahead of schedule. They were thinking 2.8. The unemployment rate is worryingly rising. It keeps rising. It's at 4.1%. And the Fed seems to be definitely behind. Like, why are rates at multi-decade highs if inflation is only a little bit above target and unemployment is rising? They definitely should cut rates tomorrow, but they're not going to, because that's just not the Fed's style. There are three reasons for this. So the modern Fed, they never want to surprise the markets. The Swiss National Bank, they could just cut rates and say, I forgot to tell you guys. Surprise, but the Fed is not like that. So they're very cautious. What they'll do tomorrow is to carefully set up rate cuts for September. Mm-hmm. Another reason they're not going to cut is this Fed has had egg on its face for 2 years. Now, remember, they were all insistent on transitory inflation, but that was not the case at all. Then again, last December, they were thinking mission accomplished, only to see inflation roar back up the first quarter of this year. Now, they don't want that to happen again, so they've been extra conservative. And one last reason they just won't move tomorrow is that Chair Powell has noted that this shift towards a rate cutting cycle is a big deal. Now, recall in January, the market was pricing in as many as 7 cuts this year. So the market is really sensitive to this, right, and they don't want risk assets to go crazy.
So last week, Bill Dudley, who was, of course, in charge of the New York Fed at one point, said he changed his mind. It was last week or the week before, right? And said, that July should be on the table. Here's the thing. You gave us 3 reasons why they wouldn't do it. Let's not forget that in 2019, Dudley also urged the Fed not to cooperate with Donald Trump. This guy hates Trump so much, and that brings in the political aspect, right? If they were to cut tomorrow, maybe even September, they could get some pushback from the Republican Party, no?
Absolutely. Now, as you rightly mentioned, Bill Dudley used to be the 3rd most important person in the Federal Reserve, and he seems to really not like Trump, so much so that he wrote that op-ed, which I think was very inappropriate. Now, I think these political considerations could play into how the Fed thinks, but the truth is, if you look at donation data, basically everyone who works at the Fed is a member of the Democratic Party, and a lot of people there, in my personal experience, really don't like Trump. So, they probably don't want to appear to be motivated by politics, but I really do think that that plays a role, and that actually makes them more likely to want to cut rates, even if it looks inappropriate.
Of course, Powell is a registered Republican, but you have to really be concerned about the next administration if they have a chance to, let's say, appoint a Leo Brainerd. But we'll talk about that at a different time. I want your comments, your thought on this. Yesterday, we had Stephanie Pomboy on. She sort of caused a real stir. She offered up a short-term, what she calls sort of an elegant solution, to at least to help create some demand for the insatiable Treasury issuance of securities. Take a listen, then let me get your thoughts.
We still have this massive problem where we're issuing $2 trillion plus in treasuries a year. There is a solution, and we'll see if anyone buys into it, and that is if we made treasury securities tax-free, the same way that municipal securities are tax-free, you would generate a huge new source of demand for treasuries as people took advantage of the tax-exempt status. So you'd create domestic demand for treasuries rather than relying on foreign central banks and the Federal Reserve to finance these deficits.
All right, Joe, what do you think?
I think that's brilliant, really. Now, if we were to make treasuries tax exempt on their interest, there'd be tremendous demand. What we would see is interest rates will come down a lot, and that would be really risk positive. Now, I know some people will say that, if you don't tax interest, that means we'll have fewer tax revenue. But Stephanie also points out that, because of lower interest rates, we're actually going to be saving more money on the interest expense. So it makes a lot of sense. Now, in addition to that, I think that the huge market rally that would cause would also increase capital gains tax receipts for the following year. So I think that's a really good idea. But one thing I'll note, though, is that this really just buys time. At the end of the day, we have to cut down on fiscal spending.
Yeah.
This is a great idea, but unless we stop the problem at the source, fewer fiscal spending, we're just buying time, kicking the can down the road as we've been doing for decades.
Yeah.
At the end of the day, there's no free lunch there.
And my worry would be, even if it was the most elegant solution, that the federal government would just raise more money, right? They're going to push it to the level anyway. Hey, Joe, great talking to you, my man. It's always a pleasure.
The Federal Reserve uses several tools to influence the economy. Open market operations involve buying and selling government securities to regulate the money supply. The discount policy allows banks to borrow money from the Fed at a discount rate. Reserve requirements dictate the amount of funds banks must hold on reserve. These tools help the Fed manage its primary targets, the money supply and the interest rate. While the Fed usually focuses on the interest rate as its main policy tool, the financial crisis of 2007 to 2009 and the COVID-19 recession required the Fed to develop and implement new strategies to stabilize financial markets and support economic recovery. The demand for money is influenced by the interest rates, which are a primary tool of the Federal Reserve's monetary policy. The money demand curve typically slopes downward, indicating that a lower interest rate encourages households and firms to hold more money rather than investing it in interest-bearing assets. For example, consider the scenario where the interest rate decreased from 4% to 3%. This reduction makes holding money more attractive compared to investing in U.S. Treasury bills or other financial assets, leading to an increase in the quantity of money demanded from $900 billion to $950 billion. Conversely, when interest rates are high, the opportunity cost of holding money increases because individuals and firms forego higher returns than they could earn from the interest-bearing assets. As a result, the quantity of money demanded decreases. This relationship underscores the critical role of the Federal Reserve in managing interest rates to influence economic activity. Understanding this concept is vital, especially during periods of economic instability, such as the 2007 to 2009 financial crisis or the COVID-19 pandemic through 2024. During these times, the Fed may employ various policy tools, including adjusting interest rates to stabilize the economy and ensure liquidity in financial markets. Changes in real GDP or the price level cause the money demand curve to shift. An increase in real GDP or an increase in the price level will cause the money demand curve to shift from MD1 to MD2. A decrease in the real GDP or a decrease in the price level will cause the money demand curve to shift from MD1 to MD3. The two most important variables that cause the money demand curve to shift are real GDP and the price level. An increase in real GDP means that the amount of buying and selling of goods and services has increased. An increase in the price level increases the quantity demanded of money at each interest rate, shifting the money demand curve to the right. On the other hand, a decrease in real GDP decreases the quantity of money demanded at each interest rate. Similarly, a decrease in the price level decreases the quantity of money demanded at each interest rate, shifting the money demand curve to the left. Similarly, changes in the price level affect the money demand curve. When the price level rises, each transaction requires more money. For example, during periods of inflation, consumers and businesses need more money to buy the same amount of goods and services as before. This increased need for money shifts the money demand curve to the right, from MD1 to MD2. On the other hand, if the price level falls, each transaction requires less money. For instance, during deflationary periods, the same amount of goods and services can be purchased with less money. This reduced need for money shifts the money demand curve to the left, from MD1 to MD3. By understanding these dynamics, we can see how factors like real GDP and the price level influence the demand for money and cause the money demand curve to shift accordingly. 8 times per year, the Federal Open Market Committee, FOMC, meets in Washington, D.C. to assess economic conditions and decide on monetary policy. One of the primary tools used to manage the money supply is the open market operations, which involve buying and selling U.S. Treasury securities. If the FOMC decides to increase the money supply, it orders the trading desk at the Federal Reserve Bank of New York to purchase U.S. Treasury securities. When these securities are bought, the sellers receive funds that they deposit in their banks. This process increases the reserves of these banks. In turn, banks can loan out most of their increased reserves, creating new checking account deposits and thus expanding the money supply. For example, suppose the economy is experiencing rising unemployment and slowing growth. The Fed might decide to lower interest rates to stimulate borrowing and investment. To do this, they buy Treasury securities, which increases the money supply and puts downward pressures on interest rates. This makes loans cheaper and encourages businesses and consumers to borrow and spend more, boosting economic activity. Conversely, if the FOMC decides to decrease money supply, perhaps because inflation is rising too quickly, they will sell Treasury securities. The buyers pay for these securities with their bank reserves, which reduces the amount of money that banks have available to lend. This action decreases the money supply, puts upward pressures on the interest rates, and helps to cool down an overheating economy. By managing the money supply in this way, the Fed aims to balance the dual mandates of promoting maximum employment and maintaining stable prices. The Federal Reserve manages the money supply primarily through its control over interest rates and the use of open market operations. Let's consider a scenario where the economy is facing rising unemployment and high interest rates. Think of 2021 through 2023. In such a situation, the Fed may decide to lower the federal funds rate to stimulate economic activity. 1. Identifying the problem. High interest rates discourage borrowing and spending, which can slow down economic growth and increase unemployment. 2. The Fed's response. The Federal Open Market Committee, FOMC, meets to assess the economic situation. If they decide to lower interest rates, they will do so by purchasing U.S. Treasury securities from the market. 3. Mechanism. By buying these securities, the Fed injects money into the banking system, increasing the reserves of banks. 4. Outcome. With higher reserves, banks have more money to lend, which lowers the interest rates on loans. Lower interest rates make borrowing cheaper for the consumers and businesses, encouraging spending and investment. 5. Expected result. Increased borrowing and spending help boost economic activity, reduce unemployment, and bring stability to prices. Through these actions, the Fed actively manages the money supply to address economic issues and support its dual mandate of maximum employment and price stability. For simplicity, we assume the Fed can completely control the money supply. Then the money supply curve is a vertical line. It does not depend on the interest rate. Equilibrium occurs in the money market where the two curves cross. When the Fed increases the money supply, households and firms will initially hold more money than they want relative to other financial assets. Households and firms use the money they don't want to hold to buy Treasury bills and make deposits in interest-paying bank accounts. This increase in demand allows banks and sellers of Treasury bills and similar securities to offer lower interest rates. Eventually, interest rates will fall enough that households and firms will be willing to hold the additional money the Fed has created. When the FOMC decides to increase the money supply, it orders the trading desk at the Federal Reserve Bank of New York to purchase U.S. Treasury securities from banks and other financial institutions. The funds used to purchase these securities are deposited into the seller's bank accounts, increasing the reserves of those banks. With more reserves, banks can extend more loans, thereby increasing the money supply in the economy. Conversely, if the FOMC decides to decrease the money supply, it orders the trading desk to sell U.S. Treasury securities. The buyers pay for these securities with funds from their bank accounts, which reduces the reserves in the banking system. With fewer reserves, banks have less capacity to extend loans, thus decreasing the money supply. In the figure, a reduction in the money supply from $900 billion to $850 billion shifts the money supply curve to the left, from MS1 to MS2. Consequently, the equilibrium interest rate rises from 4% to 5%. The aim of these operations is to influence short-term interest rates, such as the federal funds rate, which in turn affects overall economic activity. By increasing the money supply, the Fed aims to lower interest rates, making borrowing cheaper and stimulating investment and consumption. Conversely, by decreasing the money supply, the Fed aims to raise interest rates, making borrowing more expensive and cooling off the economic activity to prevent inflation. When the Fed increases the money supply, households and firms initially find themselves holding less money than they desire compared to other financial assets. To adjust, they sell Treasury bills and other financial assets and withdraw money from their interest-paying bank accounts. This increased demand for money causes interest rates to rise. Interest rates will continue to increase until they reach a point where households and firms are willing to hold the reduced amount of money resulting from the Fed's actions. A reduction in the money supply shifts the money supply curve to the left. Consequently, the equilibrium interest rate rises from 4% to 5%. This adjustment ensures that the quantity of money demanded matches the reduced money supply, restoring equilibrium in the money market. When determining its monetary policy targets, the Federal Reserve has two primary options: targeting a specific level of the money supply or targeting a specific short-term nominal interest rate. Historically, the Fed has found it more effective to target the interest rate. This approach became more prevalent after the relationship between the money supply measures like M1 and M2 and real GDP growth weakened in the 1980s and 1990s. In practice, the Fed focuses on the federal funds rate, which is the interest rate which banks lend reserves to each other overnight. While the Fed does not directly set this rate, it influences it by managing the supply of bank reserves through open market operations. This method allows the Fed to respond dynamically to the economic conditions. For example, during economic downturns, lowering the federal funds rate can encourage borrowing and spending, helping to stimulate the economy. Conversely, during periods of high inflation, rising the interest rate can cool down economic activity. In recent years, this approach has been critical in navigating economic impacts of events such as the 2008 financial crisis and the COVID-19 pandemic. By adjusting the federal funds rate, the Fed has aimed to support economic recovery and maintain stability. Understanding how the Fed chooses and manages its policy targets is essential for grasping broader economic strategies and their impacts for both short-term and long-term economic health. Federal funds rate is the interest rate at which depository institutions trade federal funds. the balance held at Federal Reserve banks with each other overnight. When a depository institution has surplus balances in its reserves account, it lends to other banks in need of larger balances. In simpler terms, a bank with excess cash, which is often referred to as liquidity, will lend with other banks that needs to quickly raise liquidity. The rate that the borrowing institution pays to the lending institution is determined between the two banks. The weighted average rate for all of these types of negotiations is called the effective federal funds rate. The effective federal funds rate is essentially determined by the markets, but it is influenced by the Federal Reserve through its open market operations to reach the federal funds rate target. The Federal Reserve sets a target rate for the federal funds rate, which is the interest rate at which banks lend reserves to each other overnight. The target range for this rate is determined by the Federal Open Market Committee, the FOMC, and serves as a primary tool for implementing monetary policy. The purpose of targeting the federal funds rate is to influence the economic activity, inflation, and employment. The FOMC adjusts the target rate to either stimulate the economy or cool it down. For example, during periods of economic downturns, such as the COVID-19 pandemic, the FOMC lowered the target rate to nearly zero to encourage borrowing and spending. Conversely, when inflationary pressures rise, the FOMC increases the target rate to make borrowing more expensive, thereby slowing down the economic activity. The figure shows the effective federal funds rate alongside the target range set by the FOMC. From 2016 to 2019, the effective funds rate was slightly above the target range, reflecting a tightening of the monetary policy stance. However, during the pandemic, the rate dropped to nearly zero, which is the actual rate falling below the target range to provide maximum economic support. As the economy recovered, the FOMC gradually increased the target rate, with the effective rate rising above 5% by early 2024, indicating a shift towards controlling inflation. By adjusting the target federal funds rate, the FOMC utilizes its tools such as the open market operations discount policy and reserve requirements to manage monetary supply and achieve its dual mandate of price stability and maximum employment. This dynamic adjustment helps to navigate the economy through various phases of business cycles and ensuring long-term economic stability. Changes in interest rates have a significant impact on aggregate demand, which is the total level of spending in the economy. While government purchases remain unaffected, consumption, investment, and net exports respond to fluctuations in the interest rates. Here's how. Consumption. When interest rates are low, borrowing costs decrease, encouraging consumers to buy more goods on credit, particularly durable goods, like cars and appliances. Additionally, lower interest rates reduce the incentive to save, promoting households to spend more. Investment. Firms are more likely to invest in capital projects when interest rates are low because the cost of borrowing is cheaper. This leads to increased spending on new equipment and expansion projects. Furthermore, lower interest rates make stocks more attractive, allowing companies to raise funds by issuing more stock. Residential investment also rises as lowering mortgage rates make buying homes more affordable. Net exports. Interest rates in the United States relative to other countries affect the value of the dollar. When U.S. interest rates are lower, the dollar depreciates, making U.S. goods cheaper for foreign buyers and boosts exports. And conversely, higher U.S. interest rates attract foreign investment, increasing the value of the dollar and making U.S. goods more expensive abroad, thus reducing exports. Let's consider a recent example. During the COVID-19 pandemic, the Federal Reserve lowered interest rates to near zero to stimulate economic activity. This policy led to increased borrowing and spending by consumers and businesses, supporting economic recovery. However, as inflation pressures grew in 2021 and 2022, the Fed began raising interest rates to curb excessive spending and inflation, highlighting the delicate balance the Fed must maintain in managing economic growth and stability. Expansionary monetary policy is a tool used by the Federal Reserve to stimulate the economy by decreasing interest rates, which in turn increases real GDP. This approach is particularly effective because lower interest rates boost consumption, investment, and net exports. The Fed implements this policy when the short-run equilibrium real GDP is below the potential real GDP, aiming to bridge the gap. In the ADAS model, the process can be visualized as follows. Initially, the economy is at point A, where the aggregate demand curve AD1 intersects the short-run aggregate supply curve SRAS, resulting in a real GDP of $16.8 trillion and a price level of 108. The Fed's expansionary monetary policy shifts the aggregate demand curve to the right, from AD1 to AD2. This shift leads to new equilibrium at point B, where the increased aggregate demand curve results in a higher real GDP of $17.0 trillion and a price level of 110. Through this mechanism, the Fed can achieve its goal of high employment by ensuring that real GDP aligns with the potential level. This increase in aggregate demand encourages firms to hire more workers, thereby reducing unemployment and stimulating economic growth. Sometimes the economy may be producing above its potential GDP, leading to inflationary pressures. In such situations, the Federal Reserve may implement contractionary monetary policy to stabilize prices by increasing interest rates. In this context, contractionary monetary policy aims to reduce inflation by reducing aggregate demand. This is done through the actions such as selling government securities, which reduces the money supply and raises interest rates. For instance, in Panel B, the short-run equilibrium at point A with real GDP of $17.2 trillion and the price level at 112. This level of real GDP exceeds the potential GDP, leading to an upward pressure on wages and prices. By enacting a contractionary monetary policy, the Federal Reserve causes aggregate demand to shift leftward from AD1 to AD2, decreasing real GDP from $17.2 trillion to $17.0 trillion, and lowering the price level from 112 to 110, moving to point B. The real GDP back at its potential level, the Fed achieves its goal of price stability. The strategy ensures long-term economic growth by preventing runaway inflation, which can erode purchasing power and destabilize the economy. Adjusting the federal funds rate has historically been an effective method for the Fed to stimulate the economy. However, during the financial crisis of 2008, this approach began to lose its effectiveness. Banks were hesitant to lend out reserves because they perceived a high risk in making new loans, even though the federal funds rate was maintained at zero. This situation is referred to as a liquidity trap, where the Fed's traditional tool of lowering interest rates was insufficient to stimulate the investments. To address this, the Fed implemented unconventional monetary policies, such as quantitative easing, QE, and operational twist. QE involves the Fed purchasing long-term securities to increase the money supply and encourage lending and investment. Operation Twist, on the other hand, involved the Fed selling short-term Treasury securities and using the proceeds to buy longer-term Treasury securities to lower long-term interest rates. The total reserve balances maintained by the Federal Reserve banks. Notice how these balances remained relatively stable until 2008, then fluctuated significantly. particularly peaking during the COVID-19 recession in 2020. These measures were aimed at lowering long-term interest rates, promoting investment, and supporting economic recovery during periods when the traditional monetary policy tools were no longer effective. In response to the 2008 financial crisis, the Federal Reserve adopted unconventional monetary policies to stimulate the economy. Traditional methods, such as adjusting the federal funds rate, became less effective due to the liquidity trap. Therefore, the Fed initiated quantitative easing, QE, expanding its purchases to include long-term Treasury notes and mortgage-backed securities, rather than just short-term securities. This effort aimed to lower long-term interest rates and encourage investments and spending. Subsequent rounds of QE, known as QE2 and QE3, further supported economic recovery by continuing these large-scale asset purchases. Additionally, the Fed introduced Operational Twist, which involved buying long-term Treasury securities and selling short-term securities. This operation sought to decrease long-term interest rates, stimulating aggregate demand and promoting economic growth. Through these measures, the Fed significantly expanded its balance sheet, representing long-term increases in the money supply. These policies highlight the Fed's commitment to using a range of tools to manage the economy, especially during periods of severe financial distress. While our models show a clear and precise adjustment of aggregate demand through monetary policy, real-world application is much more complex. The Federal Reserve aims to mitigate the impacts of recessions, but completely eliminating them is unrealistic. The best outcome is often making a recession milder and shorter. One major challenge is the timing policy of interventions. Economic data is typically reported with a lag, meaning the Fed's decisions are based on past information. For instance, during the COVID-19 pandemic, rapid changes in economic conditions required swift responses. Yet, the full extent of economic downturns was often realized only in hindsight. Another example is from November 2001, when the National Bureau of Economic Research, the NBER, declared that a recession had started in March 2001. By the time of this announcement was made, the recession had already ended, illustrating the delay in recognizing economic trends. Overall, the Fed's goal is to stabilize the economy as much as possible, but the inherent delay in data reporting and the unprecedented nature of economic fluctuations make this a challenging task. In this slide, we explore the critical issue of timing in monetary policy. Effective monetary policy isn't just about making the right decisions, but also about implementing them at the right time. The long-run growth trend. The black line represents the potential growth trajectory of the economy, assuming there are no business cycle fluctuations. The business cycle. The red line illustrates the actual path of real GDP, which fluctuates due to the business cycle and various external factors. Misaligned policy response. The blue line shows what can happen if the Federal Reserve's monetary policy is poorly timed. Let's consider a hypothetical scenario. Recession begins. Suppose a recession starts in August 2016, but due to the lag in the economic data, the Fed doesn't recognize it immediately. Delayed action. By June 2017, the Fed realizes the recession and begins expansionary monetary policy. However, by this time, the economy has already started to recover naturally. Overcompensation. Keeping interest rates low for too long can overstimulate the economy, causing a real GDP to exceed its potential. This can lead to high inflation. Increased demand pushes prices up, resulting in higher inflation. Severe next recession. The economy becomes more vulnerable to the next downturn, making it potentially more severe. Monetary policy can broadly be categorized into two types: expansionary, loose or easy, and contractionary, tight. These policies influence the economy through a series of interconnected steps, which we will summarize here. expansionary monetary policy, loose or easy policy. Initial action, the Federal Reserve lowers the federal funds target rate. Market reaction, lower interest rates decrease the cost of borrowing. Spending increases. Businesses and consumers are more likely to take loans for their investments and spending. Aggregate demand rises. Increased spending boosts aggregate demand in the economy. Economic growth. Real GDP increases, moving toward or even beyond potential GDP. Employment. Higher demand for goods and services raises employment levels. Inflation pressure. As the economy grows and employment increases, upward pressures on prices, inflation, may occur. Contractionary monetary policy, or the type policy. Initial action, the Federal Reserve raises the federal funds rate target. Market reaction, higher interest rates increase the cost of borrowing. Spending decreases. Businesses and consumers are less likely to take loans for investment and spending. Aggregate demand falls. Decreased spending reduces aggregate demand in the economy. Slowing economic growth. Real GDP growth slows down, potentially preventing the economy from overheating. Employment. Lower demand for goods and services may reduce employment levels. Inflation control. Reduced spending helps control inflation, stabilizing prices in the economy. In the dynamic ADAS model, the economy experiences two primary trends: continuous inflation and long-term growth. Each year, the long-run aggregate supply LRAS curve shifts to the right, reflecting potential GDP growth. Aggregate demand, AD, generally increases faster than LRAS, pushing economic expansion and typically leading to higher price levels. The short-run aggregate supply, SRAS, curve also shifts right annually, though usually at a lower rate than AD, further contributing to inflationary pressures. By considering these dynamic factors, the Fed can better tailor its monetary policy to manage economic growth and control inflation. For example, understanding the usual rates of growth and inflation helps the Fed set appropriate targets for interest rates and other policy tools. In normal economic conditions, the Federal Reserve targets the federal funds rate as its primary tool for monetary policy. However, there has been historical debate about whether the Fed should instead target money supply. Monetarism and the monetary growth rule, monetarists, led by Nobel laureate Milton Friedman, advocated for targeting the money supply rather than interest rates. Friedman proposed a monetary growth rule, which suggests the money supply should be increased at a steady rate, aligned with the long-run growth rate of the real GDP. The argument for this approach was based on the belief that an active countercyclical monetary policy, where the Fed adjusts policy in response to economic changes, could potentially destabilize the economy. Instead, a consistent increase in the money supply would provide greater economic stability. Historical context. Monetarism gained popularity in the 1970s when the relationship between money supply and economic variables appeared more predictable. By the 1980s, the correlation between the money supply, especially measures like M1, the real GDP, had weakened. Changes in the money supply no longer reliably predict changes in the real GDP or inflation. Current perspectives. Today, the Fed primarily uses the federal funds rate to influence economic activity because of the breakdown in the relationship between the money supply and economic outcomes. Targeting the money supply is not seriously considered in modern monetary policy due to its unpredictable effects on the economy. Conclusions. The debate highlights key challenges in monetary policy, choosing the right target that provides the best balance between economic stability and growth. While targeting interest rates remains the favored approach, Understanding the historical context and arguments for money supply and targeting provides valuable insights into the complexities of economic management.
In 1973, Japanese housewives going to market were faced with an unpleasant fact. The cash in their purses seemed to be losing its value. Prices were starting to soar as the awful story of inflation began to unfold once again. The Japanese government knew what to do. What's more, they were prepared to do it. When it was all over, economists were able to record precisely what had happened. In 1971, the quantity of money started to grow more rapidly. As always happens, inflation wasn't affected for a time. But by late 1972, it started to respond. In early 73, the government reacted. It started to cut monetary growth, but inflation continued to soar for a time. The delayed reaction made 1973 a very tough year of recession. Inflation tumbled only when the government demonstrated its determination to keep monetary growth in check. It took 5 years to squeeze inflation out of the system. Japan had attained relative stability. Unfortunately, there's no way to avoid the difficult road the Japanese had to follow before they could have both low inflation and a healthy economy. First, they had to live through a recession until slow monetary growth had its delayed effect on inflation. Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first, and the good effects only come later. That's why it's so hard to persist with the cure.
When setting monetary policy, the Fed has to choose between targeting the interest rate or the money supply, because the two are inherently linked through the money demand curve. This means that if the Fed targets a specific rate, it must adjust the money supply accordingly to achieve that rate. Conversely, if it targets the money supply, the interest rate will be adjusted based on the equilibrium in the money market. For instance, if the Fed decreases the money supply, the resulting availability of money leads to higher interest rates as the demand for the available money increases. Conversely, increasing the money supply would typically lower the interest rates due to the higher availability of money. In this figure, the Fed can choose to target either the money supply of $900 billion or an interest rate of 5%. However, it cannot target both simultaneously because these targets represent different points of equilibrium in the money market. Thus, the Fed must prioritize one of the targets over the other to effectively manage monetary policy. The Taylor rule is a rule developed by John Taylor that links the Fed's target for the federal funds rate to economic variables. According to the Taylor rule, the Fed should set the target for the federal funds rate so that it is equal to the sum of the inflation rate, the equilibrium real federal funds rate, and two additional terms. First, the difference between the current inflation and the target rate, the inflation gap. The second, the percentage difference between the real GDP and the potential real GDP, the output gap. The inflation gap and output gap are each given weights that reflect their influence on the federal funds target rate, with rates of 1/2 for both gaps. We have the following Taylor rule. Federal funds target rate, current inflation rate, plus equilibrium real federal funds rate, plus quantity of 1/2 times inflation gap, plus 1/2 times the output gap. During the mid-2000s, the actual federal funds rate was lower than the predicted federal funds rate. Some economists, including Taylor, argue that these low targets for the federal funds rate contributed to an excessive increase in spending on housing. Inflation targeting is a framework for constructing monetary policy that involves the the central bank announcing its target level of inflation. After many years without an explicit target, the Fed announced in 2022 that it would attempt to maintain an average inflation rate of 2% per year. With inflation targeting, the Fed can still respond to periods of economic problems without following an inflexible rule. However, an inflation target allows monetary policy to focus on inflation and inflation forecasts, except during severe recessions. Inflation targeting is a policy where a central bank sets an explicit target for the inflation rate and aims to steer actual inflation towards its target rate through monetary policy tools. This approach has both proponents and critics, each presenting valid arguments for and against it. Arguments for inflation targeting: stability and predictability. Proponents argue that inflation targeting provides a clear and transparent framework that helps anchor inflation expectations. This can lead to greater economic stability and predictability, which is beneficial for both consumers and businesses. Accountability. By setting a clear target, central bank is held accountable for its performance in controlling inflation. This transparency can build public trust and enhance credibility of the central bank. Focus on long-term goals. Inflation targeting can help central banks focus on long-term economic health rather than short-run political pressures. This can lead to more prudent and effective monetary policy decisions. Reductions of inflation volatility. A stable and predictable inflation rate reduces the uncertainties associated with volatile price levels. This can lower risk premiums demanded by investors, reduce borrowing costs, and promote economic growth. Avoidance of hyperinflation. Keeping inflation in check, inflation targeting can prevent the economy from experiencing runaway inflation or hyperinflation, which can have devastating effects on economic stability. Arguments against inflation targeting. Reduced flexibility. Critics argue that focusing too narrowly on inflation targets can limit central banks' flexibility to respond to other economic issues, such as unemployment or financial instability. Lagged effects. Monetary policy affects inflation with a significant lag. Relying on inflation forecasts, which may not always be accurate, can lead to inappropriate policy responses that exacerbate economic fluctuations. Neglect of output and employment. An exclusive focus on inflation may cause central banks to neglect the other important economic objectives, such as maximizing employment and output. Potential for overemphasis. There is a risk that the central bank may place too much emphasis on hitting the inflation target at the expense of broader economic stability. This can lead to suboptimal outcomes, especially in times of economic stress. Complexity of measurement. Inflation is influenced by many factors, some of which are beyond the central bank's control. Measuring and targeting inflation accurately can be challenging, and misjudgments can lead to policy errors. In summary, while inflation targeting can help maintain price stability and anchor inflation expectations, it is not without its drawbacks. The debate continues on whether the benefits of inflation targeting outweigh its potential limitations and whether it should be the primary focus of central bank policy. Federal Reserve policymakers evaluate changes in inflation by monitoring several different price indices. A price index measures changes in the price group of goods and services. The Fed considers several price indices because different indexes track different products and services, and because indices are calculated differently. Therefore, various indices can send diverse signals about inflation. The Fed closely tracks several inflation measures, including the Consumer Price Index, the CPI, the Producer Price Index, PPI, issued by the Department of Labor. However, the CPI can be too volatile for the Fed to rely on exclusively. The CPI measures the average changes over time in the prices paid by urban consumers for the market basket of consumer goods and services. While it is a useful indicator of inflation, the CPI can be affected by temporary price shocks, such as those caused by natural disasters or geopolitical events. These temporary changes can create volatility that does not accurately reflect the underlying inflation trends. Therefore, the Fed uses additional measurements to get more stable and more comprehensive understanding of inflation. This broader approach helps the Fed to formulate monetary policy that aims to achieve stable prices, maximum employment, and moderate long-term interest rates. The Producer Price Index, PPI, reveals details important to U.S. businesses but does not directly relate to consumer costs. It is rather volatile compared to the other measures. This volatility may be favorable for businesses to understand what is happening in the economy, providing insights into price changes at the wholesale level. However, on a national, macroeconomic level, it may show too much resolution, making it less useful for the Fed's broader goal of stable and predictable inflation targeting. The PPI's sensitivity to intermediate changes can obscure the long-term trends necessary for effective monetary policy decisions. Therefore, while the PPI is valuable for certain analyses, it is not a primary tool the Fed uses to gauge overall inflation. The Federal Reserve previously relied on the PCE, the Personal Consumption Expenditures Index, to measure inflation. This index is derived from the GDP deflator and provides a broader measure of inflation by tracking the prices of goods and services consumed by individuals. However, the Fed shifted its focus to the core PCE index, which excludes food and energy prices due to their volatility. The core PCE index offers a more stable view of inflation trends, making it a more reliable indicator for monetary policy decisions. During the 2020 recession caused by the COVID-19 pandemic, the Federal Reserve took significant actions to stabilize the economy. One of the outcomes of these actions was a rapid increase in asset prices, particularly on the stock and housing markets. This led to concerns about potential asset price bubbles. A bubble occurs when the asset prices rise significantly higher than their intrinsic value, driven by investor behavior rather than fundamental economic factors. There are two primary drivers of asset price bubbles, including herding behavior and speculation. Herding behavior occurs when investors make decisions based on the actions of others rather than their analysis of asset value. This can lead to price being pushed up as more investors buy into the market, believing that the value will continue to rise. Speculation involves buying assets with the hopes that their price will continue to increase, allowing the investor to sell at a profit before any potential decline. This behavior can inflate the asset prices beyond their actual worth. An example of such a bubble occurred in the housing markets during the mid-2000s. As the Federal Reserve lowered interest rates in response to the 2001 recession, demand for housing increased. This led to rapidly rising home prices, fueled by speculative buying and herding behavior. By 2005, many economists believed that a housing bubble had formed, with home prices far exceeding the value of the services they provided. This misalignment between asset prices and underlying value eventually led to the housing market crash and the financial crisis of 2008. During the 2020 recession, similar concerns arose as the Fed's policies led to significant increases in asset prices. These actions were necessary to stabilize the economy, but they also highlighted the risks of creating new asset price bubbles. During the mid-2000s, many economists argued that the bubble had formed in the U.S. housing market. Housing prices increased far more than rents, indicating a significant imbalance. High prices led to increased investments in new home construction on a surge in subprime loans. Subprime loans are mortgages granted to borrowers with poor credit histories. This credit surge was unsustainable and when the housing market began to cool, the bubble burst, leading to significant economic turmoil. The housing market bubble burst had profound implications for the economy. The peak in housing sales around 2005 declined sharply by 2010, causing a significant drop in home prices. The peak reached again in October 2020, post-COVID, saw another sharp decline, indicating the formation and bursting of another bubble. This cyclical nature of housing bubbles showcases the delicate balance the Federal Reserve must maintain in stimulating the economy without creating unsustainable growth. The Fed's role in managing interest rates and monetary policy is crucial in preventing such economic disruptions. The formation and bursting of housing market bubbles illustrates the complexities of economic cycles. In the mid-2000s, the surge in housing prices and subprime lending led to a significant bubble. When this bubble burst, it resulted in a dramatic decline in home sales and prices, contributing to the Great Recession. The Fed's response to such crises involves adjusting interest rates and monetary policy to stabilize the economy. However, the post-COVID-19 housing market surge and subsequent decline in 2020 highlights the challenges of preventing such bubbles. The Fed must carefully balance stimulating the economic growth and avoiding unsustainable asset price inflation. Until the 1970s, commercial banks and savings and loans kept the mortgages they granted until they were fully paid off, which limited the number of mortgages they could provide. To increase home ownership, Congress facilitated the creation of a secondary market of mortgages. This was made possible through the Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac. These government-sponsored enterprises, GSEs, reassured investors by purchasing mortgages from the banks and reselling them as securities. This flow of funds from investors through Fannie Mae and Freddie Mac to banks significantly expanded the mortgage market. By the 1990s, this secondary market was well established, allowing more individuals and families to borrow money to buy houses. By the 2000s, investment banks had become major players in the mortgage market. They began buying mortgages, building them into mortgage-backed securities, MBS, and reselling them to investors. These securities were appealing because they offered high returns with seemingly low risk. However, this influx of money into the mortgage market led to the creation of riskier loans, including subprime loans, mortgages issued to borrowers with poor credit histories, Alt-A loans, mortgages given without full documentation of income, low down payment loans, mortgages requiring minimal initial payments, adjustable rate mortgages, ARMs, loans that started with low interest rates, which would increase over time. This shift had significant consequences. Attractive investments. MBSs provided higher returns than other securities with similar risk profiles, drawing in many investors. Lax lending standards. With more capital available, lenders loosened their standards, resulting in an increase in higher risk loans. Market vulnerability. As housing prices began to decline, the value of MBSs fell sharply, causing substantial losses for banks holding these securities and leading to financial instability. These changes culminated in the financial crisis of 2007 to 2008, highlighting the crucial role of investment banks and mortgage-backed securities in the beginning of the market's dynamics. This crisis underscores the dangers of high-risk lending practices and the interconnectedness of the financial system. A leveraged loan is a loan extended to companies and individuals that already have considerable amounts of debt. Lenders consider leveraged loans to carry a higher risk of default, and as a result, a leveraged loan is more costly to the borrower. Consider the real estate investor that has $50,000 in cash. This investor could use that money to buy one home valued at $50,000. If that home could be quickly sold for $55,000, the investor would have gained $5,000. If that same investor used the original $50,000 in cash to put a $5,000 down payment on 10 different houses valued at $50,000 each, financed the rest of the money, and then sold all 10 homes for $55,000 each, the investor's profit would have been $50,000. An astounding 100% return on investment. Well, suppose the investor would use the 10 down payments of $5,000 each to purchase 10 homes valued at $50,000 each. If real estate prices fall, and those homes are now worth only $45,000 each, the investor would take a $50,000 loss, 100% of the additional amount invested, if the homes even sold. If the value of the homes fell to $40,000 each, the buyer's potential loss of $100,000 is 200% of the original investment amount. In each scenario, the buyer would also need to continue making mortgage payments, including interest and insurance payments, in addition to periodic home maintenance. In these scenarios, the losses can add up quickly, and the amount lost can become substantial. Thus, we see the risk of leveraged loans. The bursting of the housing bubble had far-reaching consequences, particularly due to the prevalence of lower-quality loans. As housing prices fell, a higher-than-expected number of these loans defaulted. This caused the market for mortgage-backed securities, which were based on those loans, to become very illiquid. Few people or firms were willing to buy these securities, leading to a rapid decline in their prices. Commercial and investment banks, which had heavily invested in mortgage-backed securities, faced substantial losses. The severity of these problems prompted the Federal Reserve and the U.S. Treasury to intervene with unprecedented measures to stabilize the financial system. This intervention included providing liquidity to banks purchasing troubled assets and implementing new regulations to prevent a future crisis of similar magnitude. It's easy to think that targeting inflation locks the Fed into a rigid position. But the truth is, inflation targeting is more of a guiding star than a strict rulebook. While the Fed keeps its eye on long-term inflation targets to maintain stability, it still has the flexibility to adjust policies in the short term to respond to emerging economic issues. By anchoring inflation expectations, the Fed creates stability while leaving room to address unforeseen economic shocks or downturns when necessary. The CPI is a popular measure, but it is not the only tool in the Fed's toolbox when gauging inflation. The Fed also looks at other indices like the Producer Price Index, the PPI, and the Personal Consumption Expenditures, PCE Index. Each of these measures offers a different lens. For example, when the CPI focuses on the prices paid by consumers, the PPI looks at prices from the perspective of producers, and the PCE includes a broader scope of personal consumption. Together, these measures help the Fed get a fuller, more nuanced view of inflation trends. Investment banks do more than just handle stock trades. They play a pivotal role in the many financial markets, including the housing sector. By buying, bundling, and reselling mortgages as mortgage-backed securities, investment banks significantly influence the mortgage market. This process helps channel funds into home lending, but it can also introduce risks, as seen during the 2008 financial crisis. The interconnections between investment banks, housing markets, and financial stability are far-reaching, showing how integral these institutions are to the broader economy. While it's true that the lowering interest rates can spur economic growth, it's not a silver bullet. Prolonged periods of low interest rates can create unintended consequences, such as asset bubbles. We've seen this in both early 2000s and again in 2020 when the housing market became overheated. Cheap borrowing costs led to overinvestment, risky lending practices, and ultimately, economic instability. The key takeaway here is that while lowering rates can provide short-term benefits, it must be done cautiously to avoid long-term economic disruptions. The secondary mortgage market is a double-edged sword. On one hand, it increases liquidity, allowing lenders to offer more home loans, which can be beneficial for the housing market. But, on the other hand, if not managed carefully, it can lead to risky lending behaviors. The 2008 financial crisis was a stark reminder of this, when the proliferation of subprime mortgages and mortgage-backed securities contributed to the collapse of the housing market and the broader financial instability. This highlights that while the secondary markets offer advantages, it can also be a source of vulnerability if poorly regulated. As we wrap up this session, remember that monetary policy is not a one-size-fits-all solution. The complexities we've discussed today highlight the delicate balance in the Federal Reserve and central banks around the world must strike to promote economic stability while navigating unpredictable global forces. Misconceptions about the Fed's power and limitations often obscure true challenges they face. But with a deeper understanding, we can better grasp how economic decisions impact every aspect of our daily lives. Stay curious, stay informed, and continue to engage with these critical economic discussions, because the policies we analyze today shape the world we live in now and tomorrow.